Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Oklo.
If you find our talks useful, please consider subscribe, like, and comment underneath. All right, with that out of the way, I want you to picture really a collision course that is shaping the next decade of infrastructure.
Oh, absolutely.
On one side, you have this absolute explosion of artificial intelligence. We're talking about hyperscalers deploying these massive data centers that, honestly, consume as much electricity as a mid-sized European nation.
Yeah, it's wild. It's all driven by the insatiable power demands of those next-generation GPUs.
Right. And then, on the exact opposite side, you have the notoriously complex, highly regulated world of advanced nuclear energy. Today, we are looking at the exact point where those two worlds just smash together.
It's the ultimate AI to atoms narrative.
Exactly.
It really represents a fundamental paradigm shift in how we power the future. I mean, we are analyzing a company sitting at a massive $9.4 billion market cap, yet they have virtually zero current revenue. Right, zero. To put that in perspective for you, projected revenue for 2026 is a completely negligible $0.1 million.
Wow.
So we are going to unpack how a financial setup like that can still command a 7 out of 10 bullish rating from analysts, and why pre-revenue entity is being treated as critical infrastructure by the biggest tech conglomerates on the planet.
Okay, let's unpack this, because if you look at the stock chart today, you are seeing a brutal 50% drop in their share price.
Yeah, it's been rough.
So the core mission for us today is to figure out if you're looking at a classic falling knife that's just going to decimate your portfolio, or, and this is the big question, if this massive sell-off represents a generational entry point into the backbone of AI power generation.
Right.
Because the pre-revenue status is staggering, but the entire valuation basically hinges on what happens after 2026. Specifically, this legally binding agreement they signed with Meta to supply 1.2 gigawatts of electricity.
Yeah, and that 1.2 gigawatts, that is really the anchor of the whole bullish thesis.
A lot of juice.
It is. I mean, in traditional residential terms, that is a massive amount of power. But in the AI sector, 1.2 gigawatts is just what it takes to run hundreds of thousands of those high-performance chips, like the NVIDIA H100s, continuously.
Without a break.
Exactly. Meta needs that level of power exclusively to feed their trillion-parameter AI models without interruption. But the critical nuance here, and this is huge, is that full capacity realization for this Meta deal isn't expected until 2034.
See, a 2034 timeline, that just feels like an eternity in the tech sector.
Oh, yeah.
Where product cycles are measured in, months. But the mechanism of how they plan to generate that power is what actually justifies playing the long game here.
Yeah, that's the key.
Because most traditional energy companies, they operate on a linear supply chain. They buy raw fuel on the highly volatile global market, they burn it, and then they have to manage the waste.
Right, and if global uranium prices spike, their margins just evaporate completely.
Yes, exactly. But Oklo operates on a vertically integrated owner-operator model. They use this fast fission technology, which means they can actually take the spent nuclear fuel from older, traditional reactors, which, by the way, still contains roughly 95% of its potential energy, and recycle it.
It's incredible.
It really is. It's akin to an airline that somehow possesses the technology to refine its own jet fuel from the exhaust of the planes flying ahead of it.
That's a great way to put it. And, if we connect this to the bigger picture, that fuel recycling thesis is a singular mechanism that makes them a potential cost leader for 2047 AI data center power.
Because AI does not sleep.
No, it doesn't. You cannot power a massive language model training cluster on wind or solar alone. The intermittency is a deal breaker.
Right. When the wind stops or the sun sets, the GPUs cannot simply power down.
Exactly. Hyperscalers require unwavering baseload power. So, by recycling existing nuclear waste, they dramatically lower their long-term variable costs and completely isolate themselves from geopolitical uranium supply shocks.
Which is huge right now. And that vertical integration, it creates this incredibly deep regulatory moat. I mean, you cannot simply spin up a Silicon Valley startup to process radioactive materials.
Definitely not.
You need federal permission to even touch the building blocks of this tech.
Yeah, the regulatory hurdles in the nuclear sector act as a massive, massive barrier to entry. If you look at the broader landscape of small modular reactor developers, competitors like NuScale have faced severe, very public setbacks.
Oh yeah, huge cost overruns.
Right, cost overruns and canceled municipal contracts. But in stark contrast, they have successfully secured a nuclear safety design agreement with the Department of Energy.
Which is rare.
It's extremely rare. And beyond that, they've obtained a Nuclear Regulatory Commission materials license for their atomic alchemy division.
Right.
That specific license is not just a piece of paper. It legally permits them to handle, process, and fabricate the radioactive materials themselves. It's an incredibly rare regulatory green light for a private company, essentially allowing them to control their own fuel supply chain.
Okay, I have to push back on the optimism here for a second, because historical precedent in the nuclear sector is flashing major warning signs.
Fair enough.
When you look at projects like the Vogtle plant in Georgia, you see construction that ran billions of dollars over budget and stretched over a decade past its deadline.
Mm-hmm.
And we are talking about a company that isn't expecting to fully deliver on the meta contract until 2034. So how can the market justify handing over a multi-billion-dollar valuation to a company facing a decade of notoriously unpredictable construction and regulatory hurdles before they even flip the switch?
Well, the history of nuclear construction overruns is the exact reason investors are skeptical. And it brings us directly to how a company survives what we call the Valley of Death.
Right, the dreaded Valley of Death.
Exactly. And in this context, the Valley of Death isn't just, keeping a few software developers on payroll while you look for product market fit.
No, it's a bit heavier than that.
Slightly. It means spending billions on specialized steel, nuclear-grade concrete, and relentless regulatory compliance over a 10-year stretch before a single dollar of revenue is ever generated. To survive that gauntlet without going bankrupt, you need a financial fortress.
And they have built that fortress. When you dig into the balance sheet, they are sitting on approximately $2.58 billion in combined cash reserves.
It's a staggering number.
Just let that scale sink in for a pre-revenue company. Over $2.5 billion in pure liquidity. And honestly, they are going to need every single penny of it because the capital expenditure projections are massive.
Oh, absolutely.
They are forecasting cash outflows in 2026 alone to land somewhere between $430 million and $550 million.
Which really brings immediate context to their recent Q4 financials. They reported a Q4 loss per share of -27 cents, missing Wall Street analyst estimates by a fairly significant margin.
So what does this all mean? Because when you see an earnings miss of that magnitude in a standard tech stock, the immediate instinct is to just dump the shares.
Right, run for the exits.
Exactly. But looking at the capital allocation here, this isn't an operational failure. They didn't lose a major contract.
Yeah.
And they aren't like burning cash on bloated executive compensation.
No, not at all.
That -27 cents represents deliberate, aggressive capital expenditure. That money is earmarked directly for physically constructing their Aurora reactor at the Idaho National Laboratory and securing their initial fuel procurement. They're building hard assets.
The capital is being deployed exactly where it needs to be, but, the bears do have a highly mathematical argument against the stock here.
What's that?
Well, if you are burning $500 million a year and you are projecting negative free cash flow stretching out into the late 2030s, that $2.58 billion reserve will eventually deplete.
Right, the math catches up.
Exactly. So the primary risk factor here is dilution. If they mismanage the construction timeline and have to issue millions of new shares to raise secondary capital, the value of the shares you hold today will be severely diluted.
Yeah. And the secondary risk, which might actually be the hardest physical bottleneck to overcome, is the fuel supply itself.
Right, the HALEU.
Yes, the HAU. We discussed their long-term recycling technology, but to jumpstart the very first fast reactors, they require this highly specialized fuel called high-assay, low-enriched uranium.
Right. Standard commercial reactors run on uranium enriched to about 5%.
Exactly. But HALEU is enriched up to 20%, allowing for these much smaller, way more efficient reactor cores. The problem is that the domestic supply chain for HALEU is, well, practically non-existent right now.
Yeah, the global supply of HALEU has historically been dominated by state-owned entities in Russia.
Which is obviously a total non-starter for U.S. infrastructure today.
Absolutely a non-starter. And this creates a severe bottleneck. If they cannot secure enough of that initial highly enriched fuel to ignite the reaction, all the regulatory licenses and meta contracts in the world won't matter.
They're just very expensive paperweights.
Pretty much. Their commercial deployment timeline could easily slip well past their 2028 target for the initial Idaho reactor.
It really is the ultimate infrastructure chicken and egg scenario. However, the counterweight to the bear case, the fears of dilution, the HAU bottleneck, the construction delays, it always circles back to that $2.58 billion cash pile.
It really does.
That liquidity entirely removes the immediate going concern risk. They have proven they have the initial runway required to navigate the nuclear valley of death without facing insolvency anytime in the near term.
That runway is crucial, but it hasn't shielded the stock from immense technical damage.
No, it has not.
We really need to analyze the recent price action because the market is currently testing the conviction of every single investor holding this equity. We are observing a severe 50% washout over the past 6 months, driving the stock down to a 9-month low.
Yeah, the chart is just completely fractured right now. It hit a dizzying 52-week peak of $193.84 when that initial wave of AI nuclear euphoria hit the market.
Yeah, everyone wanted in.
And now it has tumbled all the way down into the mid-$50 range. For the retail investor who bought the breakout at the top, that represents a massive destruction of capital.
It's painful.
Extremely. And the optics surrounding that drop are incredibly complex, particularly regarding insider activity. Because over the last 90 days, the data shows roughly $170 million in insider selling.
Yeah, but what's fascinating here is the market mechanics actually driving that specific sell-off.
Right. Context matters.
Exactly. On the surface, executives offloading $170 million in stock triggers immediate panic, but context is vital. This company entered the public markets via a special purpose acquisition company, or SPAC.
Right, the SPAC taboo.
Exactly. And the mechanics of a SPAC merger dictate that early investors and insiders have these strict lockup periods where their shares are entirely illiquid. What we are seeing is just the expiration of those lockups.
Ah, so it's a timing thing.
Yes. It is standard financial behavior for early stakeholders to diversify their portfolios and realize profits after years of holding illiquid private equity. It does not inherently signal a loss of faith in the underlying fast reactor technology.
And building on that, the trading volume during this 50% drawdown tells a very different story than simple capitulation. The volume is incredibly heavy at these lower levels. That suggests we are in the middle of a massive reaccumulation phase. You have the speculative retail buyers who chase the AI hype up to 193 washing out of the asset, and institutional investors are quietly stepping in to absorb those shares in the mid-50 range, building these long-term positions.
The tug of war between speculative washout and institutional accumulation is perfectly reflected in how Wall Street analysts are currently modeling the company.
They're all over the place.
They really are. We are seeing wildly divergent price targets based on the exact same financial data. UBS recently lowered their price target to $60, heavily weighting the execution risks, the decade-long timeline to profitability, and the massive cash burn.
Makes sense.
But conversely, B. Riley maintained a buy rating with a $92 target, focusing entirely on the macro tailwinds.
And those macro tailwinds are accelerating rapidly. We just watched Microsoft and NVIDIA publicly double down on their own AI-driven nuclear power initiatives.
Yeah, it's a clear trend now.
The entire tech ecosystem has seemingly come to the realization that intermittent renewable energy simply cannot sustain the power density required by next-generation data centers.
No, it's physically impossible.
Right. Furthermore, they aren't just waiting around for the U.S. market to mature. They recently expanded a transatlantic strategic partnership with Blycala to commercialize fast reactors globally.
And that European expansion with Blycala is a highly strategic maneuver. Europe operates under entirely different regulatory and energy security frameworks.
Right. Much different than the NRC here.
Exactly. So by establishing a foothold there, they are actively diversifying their deployment risk and validating their fast reactor technology on a global stage. It ensures they aren't entirely dependent on the U.S. Nuclear Regulatory Commission's specific timeline.
So the narrative really shifts from a purely domestic infrastructure play to a global energy solution. But for the stock to actually break out of this mid-50s consolidation zone, the market requires tangible catalysts.
Always.
Investors are looking at the next 3 months to provide a spark, starting right at the Idaho National Laboratory.
Yeah, the timeline at the Idaho site is critical. They officially broke ground there in 2025. Over the upcoming quarter, the market is laser-focused on the finalization of the Aurora reactor permits at that specific location.
Why is that permit so important?
Because in the nuclear sector, regulatory approvals are binary events. When an official permit drops, it serves as a massive, tangible de-risking milestone that gives institutional capital the green light to increase their position sizing.
Got it. We also have to overlay the macroeconomic environment onto that construction timeline, specifically the Federal Reserve's rate decisions.
Right.
It's so easy to ignore monetary policy when we're sitting here discussing nuclear physics, but the cost of borrowing is the lifeblood of heavy infrastructure.
Oh, absolutely.
When the Federal Reserve cuts interest rates, the cost of capital plummets. For a company that will eventually need to finance billions of dollars in power plant construction, a lower interest rate environment drastically improves their future profit margins and significantly reduces the threat of dilutive equity raises.
The macro environment definitely dictates their long-term survivability, but near-term sentiment will likely be driven by upcoming investor days.
Which are right around the corner.
Yep. Management is expected to provide some granular updates on their 2028 deployment target for the initial Aurora powerhouse. And, the market despises uncertainty.
Hates it.
Providing concrete operational timelines regarding that first commercial reactor is what will rebuild that institutional confidence.
Beyond the official calendar, the speculative rumor mill is providing its own upward pressure right now. There is significant market chatter regarding potential joint ventures, specifically with Centrus Energy.
Yeah, I've seen that floating around.
Right. And a formal joint venture there would be a massive catalyst because it directly attacks the HLEU bottleneck we discussed earlier. If they can announce a dedicated partnership to accelerate domestic HLEU enrichment, they completely neutralize the most potent bear argument against their deployment timeline.
We are also tracking potential inclusion in future nuclear energy ETFs.
Oh, that's huge.
Yeah. As the AI power narrative solidifies, passive index funds built around advanced energy will be forced to buy millions of shares just to match their index weightings. That creates this mechanical, price-agnostic buying pressure on the stock.
Okay, here's where it gets really interesting. Because when you synthesize the massive cash reserves, the regulatory licenses, and all these upcoming catalysts, you arrive at a highly compelling elevator pitch.
You really do.
You are looking at a battered, deep value asset relative to its initial hype cycle peak. The 50% washout has essentially eliminated the speculative premium. What remains is a highly asymmetric entry point into the defining infrastructure bottleneck of our generation.
Perfectly.
They hold the proprietary keys to the exact baseload power solution that multi-trillion-dollar tech monopolies are just desperate to secure.
And the underlying fundamentals are precisely why the consensus maintains a 7 out of 10 bullish score. When the stock trades down into the mid-50s, the market is effectively pricing in total execution failure.
Like it's going to zero.
Right. It is completely discounting the $2.58 billion in liquidity, the Department of Energy agreements, and that massive binding 1.2 gigawatt Meta contract.
Yep.
However, any investor stepping in at these levels must have a clear-eyed view of the timeline. This is not a momentum trade for the next quarter.
Yeah.
It is a multi-year infrastructure hold that requires a high tolerance for regulatory volatility. The true horizon targets the post-2028 operational milestones.
It requires patience, but the endgame of this entire AI to atoms narrative is what truly reshapes the market. The hyperscalers are deploying capital at a rate we have never seen, strictly to secure electricity.
And this raises a really important question to leave you with today.
Let's hear it.
As tech giants like Meta, Microsoft, and NVIDIA race to build these AI clusters that demand more baseline electricity than entire sovereign nations, what happens to the global balance of power?
That's a scary thought.
It is, because if independent proprietary nuclear microgrids become the only viable mechanism to keep these massive server farms operational, we are looking at a fundamental shift in infrastructure ownership.
Oh, wow.
Could we see a future where these tech conglomerates stop buying power from the local grid and instead use their trillion-dollar balance sheets to simply buy the power companies and nuclear developers outright? Do the leaders of the AI revolution inevitably become the utility barons of the 21st century?
That is a staggering shift in how we define physical infrastructure in the digital age. Thank you for joining us today for this wealth building analysis. Remember to stay curious, keep your eyes on the long-term horizon, and always look past the daily market noise. We'll catch you next time.